What is up? Welcome back to another video. Just quickly before this video starts, I just want to say here is my training course that I currently have just released. It features my strategy that has over an 80% win rate. Everything here it's beginner friendly. So if you're new to trading or if you are a bit more advanced in trading, then this trading strategy is definitely going to be perfect for you. Yeah, as I said, it is a new course, so make sure you go check it out and also join my Discord. There is a link in the description. My Discord is completely free, and I live trade every single day there. So let's jump straight into the video. In this video, I am going to be talking about fair value gaps. Now, fair value gaps are the most important ICT PDRA when it comes to trading. You want to be able to master ICT fair value gaps, and then you literally can become profitable by only using fair value gaps. Now, I trade with something called inverse fair value gaps. Now, I will go over briefly what an inverse fair value gap is towards the end of the video. But my main focus is just going to be fair value gaps in this video because you need to be able to master what a fair value gap is and how you're going to use them. And most importantly, what I'm going to be focusing on is how you're going to choose which specific fair value gap that you're going to use and then which ones you're going to avoid. So if you don't know what a fair value gap is, then all a fair value gap is there is just a imbalance in the market. So a fair value gap is literally just where price hasn't came and filled. So it is a 3 candle formation. So let's say these are candles, for example. Now all it is from the first candle and the third candle. So let's count 3 candles. So we've got 1, 2, 3 candles here. So from the first candle to the third candle, there can't be any wicks or body of a candle in between. So right here, this would be a fair value gap because as you can see, this first candle and this third candle do not touch in any way. So if we go to the chart, let's look at a bearish fair value gap. Now, knowing the difference between a bearish fair value gap and a bullish fair value gap is also very important. Okay, so all a bearish fair value gap is just the second candle in the formation is bearish, and then that will be a bearish fair value gap. So the candle where the gap actually is the candle that creates the bullish or bearish fair value gap. So if we're looking here, we count 3 candles. So 1, 2, 3. As you can see, the first candle here and the third candle has a gap. Now you might be wondering, do we delete the fair value gap off our chart, or what do we do when price action comes into the fair value gap? Oh, what just happened there then? But the answer is you don't do anything. When with ICT concepts and ICT's PDRAs, it does not matter if price action has came and tapped a fair value gap. It is still valid. Okay, we can use fair value gaps from all the way over here. They are still valid in today's price action. Now, I've had a lot of people commenting that saying, okay, this fair value gap was tapped into here, so when it comes price action comes into it now, it is invalid, and that is not correct. When you're trading with fair value gaps, they trade through price action, okay? Especially when you trade my model, which is the inversion fair value gap model. So that is an example of a bearish fair value gap because as you can see, the first candle here and the third candle there, they are not connecting in any way. As you can see, from here to here, they are not connecting. So that is a bearish fair value gap. So if we are now looking for a bullish fair value gap, as you can see, from this point here to this point here, that is a bullish fair value gap. Now, how do we know it's bullish? Because the candle in the middle is blue. It is a green bullish candle. It is going upwards. So that is an example of a bullish fair value gap. Now, you might be wondering, what is the point of fair value gaps and how do we use fair value gaps? Now, fair value gaps are literally, as I've said, they are the best ICT PDRA. You can literally be profitable from only trading ICT's concepts. Now, I use fair value gaps, but I use fair value gaps in a different type of way. So let's go to the 5 minute time frame and let's go to Friday's price action. So as we can see, we have this price action right here, which is just the open price action. Now you might be wondering what is special about this price action. Now, as you can see, we have a bullish fair value gap right here. Okay, let me just mark it out for you. We have a bullish fair value gap right here. Now, what most people would be doing is how most people use bullish fair value gaps is they like to be lunging off fair value gaps. Now, what I mean by that is if you watch some of ICT's videos before, he says that when price comes and taps into this area here, people want this bullish fair value gap to hold and come to the upside. Now, that doesn't mean you just enter off of a position as soon as price action comes into this bullish fair value gap, okay? And I actually do the complete opposite. So I know that most people are lunging this area right here because it is a bullish fair value gap. And don't get me wrong, if this bullish fair value gap holds and then we come up and we change character or we get break of structure to the upside, then this is probably going to be a valid bullish order block. But the way I like to use the order blocks is if we get a candle close below this bullish fair value gap, then it will be turned into a inversion fair value gap. Now, this is what I spoke about at the start of the video. An inversion fair value gap literally means that the bullish fair value gap is not being held bullish anymore. So what I mean by that is, as you can see right now, this bullish fair value gap is being respected. It's being used what it's meant to be used for, and that is just to support price. You don't want to see a candle close below here if you are bullish. You want to see price hold this fair value gap. It doesn't matter if there is wicks that go below this fair value gap, as long as the body, like here, is staying in this bullish fair value gap, then that is good and price action should keep going up. Now, the way I use this fair value gap is instead of just lunging from this bullish fair value gap like this, I wait for a close below the fair value gap. So if we play the price action out, as you can see, we are just chopping around, and then boom, we get a candle close right here below the bullish fair value gap. So this is where I would now say, and I would pretty much know that price action now is at least going to go for this sell side liquidity. And the reason for that is we have just inversed this 5 minute fair value gap, and as well as a 5 minute fair value gap, we've also inversed a 15 minute fair value gap. So now this is where my win rate and my model that I trade, and I teach it a lot more specifically in my trading course. There's a link in the bio, but I now know that price is going to go for this liquidity here. And as you can see, we go into this liquidity, we tap into another bullish fair value gap down here, which is really small, but on a higher time frame, that's probably a bigger fair value gap. Yep. So on the 15 minute, this is a bigger fair value gap. As you can see, we count 3 candles. 1, 2, 3. There is a gap from the first and third, so that is a 15 minute fair value gap. And yeah, as you can see, we're now respecting this fair value gap. So that is pretty much how you're going to want to use fair value gaps. You just wait, you see if they're being respected or not, and yeah, you don't have to trade fair value gaps specifically. You could use a different model. But if you use fair value gaps to your advantage, then they are extremely useful. Because price action almost uses these fair value gaps as a magnet, and because as you can see from this wick here to this wick here, there is just a gap. There's a nice gap in the market. Now this gap means that orders haven't been filled in this market, so therefore price is like a little magnet. Now don't get me wrong, you can have fair value gaps that sometimes don't get filled for a very long time, but that is quite rare. So if you just stick to using fair value gaps, especially if you're new to ICT, what you can do is just look at price from a 9:30 open, start playing the price action out and marking out all the fair value gaps you can see, and just watch how fair value gaps respect price action. Yeah, it is just very interesting, and Yeah, I hope this video helped. This is just a little sneak peek of how you want to use fair value gaps, and then I just gave one quick example of my inversion model that I teach. Now obviously I haven't taught my model 100% here. If you do want to learn that, then click the link in the description and make sure you join my Discord.